Hi, my name is Judy Raneri, and I'm the portfolio manager of the Gabelli U.S. Treasury Money Market Fund. Today, I'd like to discuss what we expect from this week's Fed meeting. We are all but certain that the Federal Reserve will keep rates unchanged on Wednesday, November 1st, maintaining the Fed funds target range at 5.25% to 5.5%. This despite stronger than expected third quarter economic activity. The committee will likely use the pause to allow more time to assess incoming data, especially in the face of the recent sharp increase in long-term yields, which it views as having tightened at least an additional 50 basis points. That, as well as allow the already 525 basis points of tightening to continue to work through the system. As for the statement, we think the committee will maintain a hawkish policy tilt, signaling additional rate increases possible given the status of the economy, especially in the context of an economy that expanded at an above-trend pace of 4.9% in the third quarter. The committee will likely acknowledge the economy continues to expand, job gains have slowed but remain strong, and inflation still remains elevated despite the recent progress. And in keeping with a hawkish bias, we anticipate that they will mention additional tightening may be appropriate if there's still evidence of persistently above-trend growth in combination with signs that the labor market is no longer easing, obviously leaving the option to do more. The press conference, we expect Powell to remain largely non-committal about the outlook for further rate increases, but maintain a slightly hawkish bias. He will have to walk a very fine line as he tries to dissuade the market from thinking that the committee has actually reached its terminal rate, given it is now pausing for a second consecutive meeting. Powell will also likely try to balance that message by underscoring that the central bank aims to proceed carefully as it plans the next policy steps amid rising uncertainties. We expect the chair to also spend time discussing the subjects of higher for longer, tighter financial conditions, and obviously the resilience of the consumer. Now, in light of the continued momentum in the economy, which risks pushing inflation higher from current levels, in combination with geopolitical issues, we expect that the Fed to deliver another 25 basis points at the December meeting, and then remain on hold through third quarter of 2024. Although we anticipate rate cuts to begin in the fourth quarter of 2024, these cuts are conditional on the economy slowing, the labor market easing further, inflation clearly getting closer to the Fed's 2% target, and geopolitical risks abating. If the economy, inflation, and the labor market does not show signs of further slowing, as projected, we would expect the theme of higher for longer to persist well into year-end of 2025. Thank you.